This video is an insight into what it's like in my e-learning platform, and I'm going to give you one of the trickiest topics for FSRE or for your CeMAP 1 exam, which is the tax stuff. So hopefully this will help. Make sure to like and subscribe, and I will link the free course stuff in the description below, as well as the course if you want to go ahead and buy. Welcome back. In this topic, we are going to do what is probably one of the biggest barriers for people with CeMAP 1, which is all to do with inflation and tax. And before I move on to either of those, we need to talk about the government, because ultimately they are the ones that influence both inflation and tax. So the government have two main roles when it comes to financial services. Their first job is to manage the economy, and their second job is to handle the regulation, because what a lot of people don't realize is that whilst we have things like the Financial Conduct Authority and the Prudential Regulation Authority, they actually take their guidance from government. So governments start at the very top. And we can look at this by splitting it into two sections. We have macroeconomics and microeconomics, and I'll explain the difference. So if we start with macroeconomics, the best way to memorize the difference between these is you think macro is bigger than micro. So macroeconomics relates to the bigger stuff. Think about things like unemployment, interest rates, inflation targets, and the levels of government borrowing. That's what covers macroeconomics. Microeconomics, on the other hand, is the smaller things. So you're going to think about things like household choices, the way that businesses price their products and services, wages in any particular sector, and market competitions when it comes to things like mortgages versus savings. So think about it like this. Macro, the big stuff, the stuff that we see on the news. Micro, the smaller stuff that you would see day to day. So regardless of which government we have in power, they all have the same main objectives, and you need to know these for your exam. So if you are making notes, make sure that these are the points that you write down. The first objective is price stability. That one's pretty self-explanatory. They don't want things to go up too much in value whilst they are in power. The second one is low unemployment. Again, pretty self-explanatory. They want people to be in jobs because that drives the economy. Then we have something called the balance of payment equilibrium, which is probably something you've never heard of before. Now, this is to do with imports and exports. In an ideal world, we would spend as much on importing stuff as we would receive in exporting stuff. Actually, that's quite a difficult thing to balance, and we've never quite gotten there, but that's what the balance of payment equilibrium refers to. And then the last one is economic growth. So is the economy growing in real terms? Now, every government wants to hit all four of these objectives. The problem is you generally can't hit all four at the same time, and I'll come on to that in a little bit more detail in a second. So if we have an economy that's growing in real terms, that means that people are spending money. The more people that spend money, the more people end up in jobs because everybody's spending. And whilst that's all well and good, generally when people are spending more money, they're also borrowing more money. And that puts pressure on interest rates for borrowing, which then hikes the price of stuff up. And as the price of stuff goes up, we start to spend less money because it's more expensive, and then people start to come out of jobs because we're not spending as much money. So it's almost like a vicious cycle, and we will come on to the economic cycle in a different topic, but that's why it's really difficult to hit all four targets at the same time. The next thing that you need to write down for your flashcards is something called fiscal policy. And if you've ever watched the news around budget time, you've probably heard of fiscal policy before, but we might not necessarily know what it means. Fiscal policy just relates to tax. So when the government talk about adjusting fiscal policies, they mean they're going to mess around with our tax brackets or how much they tax businesses. And this is because of something called the public sector net cash requirements. You do need that on a flashcard, and that is ultimately how much money we need going into the public sector. How do we control that? By how much we tax people. So a public sector like the NHS needs funding. One of the ways that the government can fund the NHS is by increasing taxes either to the public, like you and me, by our income tax bands or our inheritance tax banding, or they can look at shifting that to companies and increasing things like corporation tax rates or messing with the thresholds. That's what fiscal policy is. And now we're going to move on to the trickier bit, and it's all to do with tax. The first thing to be aware of is when the tax year runs from until. So every single year, the tax year runs from the 6th of April up until the 5th of April. When we do our taxes, if you do your own, that is when we will look at the tax year. It's not January to December. And there's two different broad categories of tax. We have direct tax, and generally income tax, inheritance tax, corporation tax, all of that stuff would fall under the direct tax bracket. We're going to do those in more detail in a second. And we also have indirect taxes. The indirect taxes are the ones you don't necessarily think about at the time. So you're going to think about things like fuel, when you pay tax on your fuel, or VAT, or stamp duty when you buy a house. All of those are classed as an indirect tax. And the first type of tax we're going to talk about is income tax. You'll all probably know what income tax is, because either you'll be employed and you get your payslip at the end of every month and you'll see your payslip and you'll be really miffed about how much tax you've paid, or you'll be self-employed and you'll have to submit your own tax earnings. So there's a couple of things that we need to know. First of all, what do we pay income tax on? This one is really important for your exam, and you're going to remember things like employed income, self-employed income, any investments, rental properties. All of those things you will pay income tax on. When it comes to thresholds, for the purposes of your CeMAP exam, you do not need to know what the income tax threshold is. They'll actually likely provide you with a tax table in your exam, but you don't need to memorize anything. So just remember the types of things that you pay income tax on, and also remember that you will pay income tax either as an employee or as a self-employed individual, but your employer will also have a role in this. So if you are employed, it's your employer's responsibility to take that tax out of your pay and then pay it directly to HMRC. If you're self-employed, it's a little bit different. So you have to declare your earnings and you have to do something called a self-assessment tax return. Now you can either do this yourself or you can pay an accountant to do it. But ultimately, it's your responsibility if you're self-employed to make sure you are paying the right amount of tax. There's also a potential responsibility even if you're in employment. So if you receive something like savings income, rental income, dividend payments, anything like that, you will also have to do a self-assessment tax return alongside your pay slips to make sure that you've paid the right amount of tax in both brackets. And as I mentioned, you'll have a personal allowance. That personal allowance does actually change dependent on how much you earn. So the way that it works is if you earn below a certain threshold, as of recording this video, it's about £12,500, you pay no income tax every year. If you earn roughly between 12.5 and I think it's £50,000, you'll pay 20% tax. Then you can go up into the 40% tax bracket or the 45% tax bracket. But just remember, you don't need to know the thresholds for your exam. Next on the list, we have national insurance contributions, and these are ultimately just an extra type of tax. They go towards things like the NHS, public transport. If you are over the age of 16, you will pay national insurance contributions, and you can fall under one of three categories. If you fall under class 1, you will be in employment. Both you as an employee and your employer will pay national insurance contributions on your behalf. If you fall under class 3, because class 2 doesn't exist anymore, they put that in the bin in 2024, class 3 is the quirky category, and this is where you would make voluntary contributions. So an example of somebody who might make voluntary contributions would be somebody who is potentially working abroad, but they want to come back to the UK when they retire. So you make national insurance contributions to get a state pension. If you know you're going to work abroad for the next 10 years, but you definitely want to come back and get your full state pension, you can voluntarily opt to make class 3 national insurance contributions. And then we have class 4, and class 4 is for people who are self-employed. Just remember, self-employed people used to pay class 2 and class 4, but they've recently put that in the bin. Next on our list, we have capital gains tax. And the easiest way to remember capital gains tax is it's the tax that you might pay on stuff if you sell it and make a profit. And it's that last sentence that's really important, because people think, well, Charlotte, I sold my sofa on Facebook Marketplace and I didn't pay tax on it. But you probably didn't make a profit on it, because what you bought it for, you're not going to sell it for more than that second hand, right? So the main things that you pay capital gains tax on are going to be things like the sale of your second house. We don't pay it on the sale of our residential property, And that's because there is an exemption that you don't have to pay capital gains tax. So the official sentence from the textbook is that you can pay it on the disposal of certain assets, and that includes shares, most investment products, and property other than your own home. You have an annual exemption or a capital gains tax allowance per year. Again, for your exam, you do not need to memorize what that figure is, so I'm not going to give it to you in this training. But the idea is you will pay it if you sell stuff and make a profit, unless it falls under the exemption list. Then we have inheritance tax. Now I am going to do a totally separate video on inheritance tax, and that's because it can be quite heavily covered in your exam. But the basic premise of inheritance tax is if somebody passes away, they pass away with an allowance. You're going to put all of that dead person's stuff into a pot and give it a value. If it is over their allowance, which at the minute is £325,000, whoever inherits that amount of money has to pay inheritance tax on it at a value of 40%. That 40% is not relevant to your income tax banding. So there's been a lot of controversy recently as of recording this regarding inheritance tax and farming. And that is because there was an exemption around farmland that meant you probably wouldn't have to pay as much inheritance tax. But now the idea is if one person dies, they're not married and they have children, they can pass on up to £325,000 worth of stuff, can be cash, can be houses, can be cars, down to their kids. Their kids don't pay any inheritance tax at all. Anything over that £325,000 bracket, their kids will have to pay 40% tax on anything that they inherit. Now, there's a couple of different quirky rules with this. One of them is something called a potentially exempt transfer, and people used this to get around inheritance tax. So what used to happen is parents who were getting a little bit older used to transfer their houses into their children's names when they were cracking on a little bit, but they were still alive. The government clocked on to the fact that that's what everybody was doing, and they made a rule that said the parent had to survive 7 years from the date of the gift. Now, that gift can be a property, but it can actually be any financial gift. If they survive 7 years, they don't have to pay inheritance tax. If they die at any point within that 7-year period, a percentage of inheritance tax is payable. So if they die within the first 3 years, they have to pay 80% of their 40% tax liability, and then it drops down in 20% increments until you get 7 years when it drops down to 0. That ruling is called a potentially exempt transfer. That is very likely to come up in your exam, so make sure you've got that one written down if you're not using the downloadable flashcards. You also have something called a chargeable lifetime transfer. This is a gift between businesses. So it's okay for people to give gifts between each other. But if a business gives a gift, or if somebody gives a gift to a business, you don't get the potentially exempt transfer rule. You get the chargeable lifetime transfer rule, which means that you have to pay the tax right now when the gift is made, not when that person or that business owner passes away. Now, from a tax perspective, well done, because we've kind of done them all. So hopefully that wasn't as stressful as you've thought. Remember, all of that falls under fiscal policy, fiscal as in tax. The other government objective is something called monetary policy. And monetary policy relates to the manipulation of things like interest rates. Because if you manipulate interest rates, you manipulate spending. Think about this in the context of mortgages. When interest rates are really high, nobody wants to buy a bigger house because it's really expensive. But when interest rates tank, all of a sudden, everybody wants to buy a bigger house with an extra bedroom and an office space. That is what monetary policy is. The government can control spending by manipulating interest rates. And if you're wondering exactly who controls this kind of stuff, it is a department within the Bank of England called the Monetary Policy Committee. These guys are made up of 9 members, and they get together 8 times a year to decide whether to increase or decrease the bank rate. Now, the bank rate is also known as the Bank of England base rate, and when that changes, interest rates right across the board will change as well. They do this to meet our inflation targets, and it is the only reason that they do this. Our inflation target as a nation is 2%. And what that means in real terms is, in an ideal world, the price of stuff would go up by 2% every year. Now, if we look at 2024 as an example, our inflation rate at the end of the year was actually 13%, so that was pretty bad. Anywhere between 1% and 3% is where we want to be, because that suggests that we have a good, growing, yet controlled economy. As we get towards the end of this topic, we need to talk about something called quantitative easing, which might be something you've not heard of before. Quantitative easing is basically how new money is created, and this is because the bank can print more money to increase the money supply. And the way that it works is they will look at private sector companies or bonds. They will particularly look at things like gilts, and they might decide to either buy them or not buy them. That's one way that this can help. But new money is created to buy those assets. That's how quantitative easing works. And there are three main ways that this affects the economy. The first one is that when the Bank of England buys assets like gilts or shares in stuff, the prices of them increase. And if they go up, that works out pretty well. Because when the Bank of England buy things like corporate bonds, conditions in the capital markets generally improve. For the purposes of CeMAP, you don't need to understand the ins and outs of that, but that's the way that it works. The third way is that as new money goes into financial institutions like banks and building societies, it means they have more money to lend. It means they can service more customers, which makes everybody happier. And all of this links to, if we can control the money supply, we can control inflation. And that is the whole goal with this, is to try and keep our inflation as a nation between 1% and 3%. The next thing that I need to talk about is something that is new to the new CeMAP textbook. One is called MO and one is called M4. So MO is known as narrow money, and this measures the cash based in the UK. Most of it is in coins or in physical cash. M4 is known as broad money. So this measures bank and building society deposits, things like loans and overdraft. Remember, the bank can manipulate interest rates to control the amount of money that's offered to consumers like us. And as we finish up, we're going to talk about two different ways to talk about interest rates. One is called a nominal interest rate, and this is the rate that is actually paid or charged on something. The other one is called the real interest rate, and the real interest rate is the rate of return on an investment. So the nominal rate is what you pay or what you're charged, whereas the real interest rate is actually what do you make if it is that we're talking about investments. And that, from a tax perspective, is everything that you need to know for your CeMAP exam. Hopefully, you've followed along well, you've made your flashcard and your notes, and I will catch you for the next video.